In this lesson, we will learn the basic practice of financial due diligence. Financial due diligence is one of the most important aspects of due diligence to be covered. It is more than just investigating financial records. It also involves examining the underlying profit, what contributes to it, and how the target company's future looks. The financial due diligence team will spend much time assessing the target company. Hence, their knowledge could also be utilized to gain an in-depth understanding of the overall commercial aspects of the target, not just their financials. The main objectives of financial due diligence are the following. First, it is a precise examination of the assets and liabilities of the target company, which will later be used in the upcoming negotiation stages. It may lower the purchase price, depending on the due diligence result. Second, it should also include items related to the income statement. If the due diligence team identifies factors that may adversely affect the target company's future performance, this may also affect the purchase price adjustment. Lastly, the buyer should be able to quantify the synergies they could create after acquiring the target company. For this, they should find out how well the target company fits into their acquisition strategy and where they could save on costs together. During this process, they may unearth any potential deal breakers. The reason for scrutiny of assets, liabilities, and future performance is that the seller controls all information about their company until the offer has been made. Most of the information they present will paint the target company in the best light to discourage buyers from dropping the deal. Therefore, potential buyers must find out if everything the seller presents is true. If they are far from the facts, stopping the deal is much wiser. Make necessary adjustments. Let's look at some common data that should be checked in financial due diligence. Of course, the following is a basic list and is by no means exhaustive. Historical financial statements. Reviewing the target company's historical financial statements is basic and crucial for assessing the company's financial performance, profitability, and cash flow. You should identify revenue, expenses, and profitability trends over time. Financial projections. Evaluating the target's financial projections is essential for assessing the company's potential for future growth and profitability. These projections are typically prepared by the target company's management team and are based on assumptions about future market conditions and company performance. Capitalization table. A capitalization table shows the target's ownership structure, including the number and type of shares outstanding, the percentage of ownership held by each shareholder, and the share price. This data helps identify potential conflicts of interest or issues related to ownership structure. Debt schedule. The debt schedule shows the target company's outstanding debt obligations, including the principal amount, interest rate, maturity date, and any covenants or restrictions associated with the debt. You need to evaluate the target company's ability to service its debts and assess the risk associated with them. Customer and sales data. Reviewing the target company's customer and sales data is important for understanding the company's revenue streams and customer base. With this data on global companies.